Well, good morning, Wealth Press viewers, subscribers, investors, and traders. It's another weekly wrap up, and today I'm joined by Jeff Yasteen. Jeff, how are you today?
I'm doing fine. Doing great.
Jeff, let's kick off the conversation. I've a bit of a headline to this morning was that the rise in subprime delinquencies in the mortgage sector have really started to spike, and I wanted to hear from you how that should temper our attitudes towards the deployment of risk capital in the week ahead.
Sure. I'm not sure in the week ahead that we're going to see that much impact from that news regarding this spike in mortgage delinquencies, only because it's leading up to Labor Day weekend, and all of us, you and I and Roger and Lance and all of us who've been appearing with you have talked quite often about how the market right now is kind of on autopilot. And I tend to believe that we'll continue to see that through Labor Day weekend, only because, again, it's just most people just either aren't paying attention, or the amount of money that's already locked up expecting, continue small move in that direction, I think is already there. But, 99.9% of the gains have already been made, in my opinion. So I wouldn't position in any way really for any huge bullish move in the next week. I think it's pretty much all baked in there, just given the level of put call ratios and that sort of thing.
Sure.
But looking out beyond that, the thing that strikes me, and I've pointed this out in some tweets in the past couple of months, back in 2000, if you recall, we saw the stock market. Of course, the dot-com bubble popped. The NASDAQ fell 40%. It rallied through the whole summer to the point that going into Labor Day weekend, the NASDAQ was only down 15%. And the S&P 500, which had a lot lower of a technology weighting in those days, almost made a new all-time high. And then suddenly on that the Tuesday after Labor Day weekend, it was like everybody on Wall Street came in and said, okay, now it's time to sell. And that's when the real move down began. And I would be very concerned about that same sort of thing happening here. Not that we fall off the table, but just that suddenly all the stuff that that did work over the past 4 months since the bottom in the pandemic panic, if you will, that suddenly everything doesn't work. And and that's a typical sort of thing you see at bull market tops and at cycle tops, where everybody's ready to buy more, and if the market falls some, they're ready to buy even more than that, and that's when people are hooked. And this delinquency thing, just to circle back to that, if we want to look for where would the recession and the economic difficulties be, again, not now, but 6 months and a year from now, that's where those would begin. And we saw that in 2006, 2007. But even there, it took till October of 2007 before the real decline began.
Right. Yeah. Well, it's interesting. The signals are contradictory right now. We've got this rising delinquency rate. We've got bailout money for individuals stalled at the congressional level. Yet another headline this morning was that the S&P 500 has had its best August since 1986. So, despite the disconnect between the market and the economy, do you really think that even in the future that all this economic weakness is likely to negatively impact the actual trading enthusiasm that has been carrying this market ever higher?
I do. And the reason why, it goes partly to what you were just saying when we talk about the best August since 1986. What does that tell you? That tells you more than anything that people have such immense optimism. And you can see that in put call ratios. And I forget the exact specifics, but I saw a headline that somebody had tweeted out yesterday, the day before that, Wednesday or Thursday, that certain put call ratios that people are looking at haven't been this high since the days of the actual dot-com bubble of right in March of 2000, before everything started to fall apart back then, 20 years ago. And I think back to a time when I started getting really bullish on the market, which was late December 2018 and early January of 2019. And if you recall, the markets had fallen for the previous 3 months, and December of 2018 was, I believe, the worst December for the market, going back to, I want to say it was like the 30s. And yet, what happened there? We rallied in a huge way. That was the point to be buying all these FANG stocks. And I owned Apple in that time. I was saying buy Apple. I said that on an interview I did with Cheddar TV. I have it on my Facebook account. So when you look at that period of negativity that so many investors had back then versus the amount of positivity and the extremes and sort of euphoria that we're seeing now, to me, that's a sign, just speaking as a contrarian here, that's a sign that you need to pull back, that you need to look for other places to make your money in the market. Now, we'd be looking at things like, again, interest rates going in the other direction, going higher, simply because that's what everybody does not expect. Looking at oil, which has moved from below zero that we saw back in the very bottom of the pandemic to now like 42, 43. To me, when I look at the charts, it's pointing higher. And you can even go onto the Energy Information Administration website, and you'll see how the number of oil platforms, both onshore and offshore, in operation are at record lows. There's like less than 300 out there operating. To me, that points towards higher oil prices as the global economy gets going post-pandemic. So sure, there are places to buy, but buying tech stocks and buying your favorites in the S&P and the NASDAQ, just to me, don't make sense.
Yeah, you bet. So then the travel stocks, the COVID travel stocks that got beat up, I mean, is there any hope for them in the weeks ahead, in the months ahead?
I believe so. I like cruise line stocks. I like airline stocks. Now, I know when I say this, somebody could easily and rightly point out, well, how can you be positive on those if you're expecting the overall economy to begin to fade and the overall market to begin to fade? The thing we always need to keep in mind are this sort of market dynamic where's the money going? The money for the last 4 months, has been going into tech stocks. That's what's been working. You should look over the next couple of weeks, especially once we get past Labor Day. If those don't appear to be working, look what is working. Look at what's still moving up. And I believe we will see this rotation from those tech stocks into some of these other beaten up sectors. And whether it means that cruise lines go to new all-time highs, I'm not so sure about that. But as a trade through the end of the year or through next spring, I definitely could see that, because those are the best times to be in those industries to begin with. So you put that as one point, and presuming we continue to get good positive news on vaccine developments for COVID-19, to me, those point to higher prices for both cruise lines and airlines.
Wow. And so how much do you think that the anticipation, the expectation for a vaccine by the end of the year, which seems to be the most common refrain we're hearing out of the mouths of politicians, how realistic do you think that is, and how much do you think that's being priced into the market at this point?
I think that is certainly priced in to a large degree on the actual vaccine or presumed vaccine developers like Moderna and AstraZeneca and those. And it seems like, lately, the last, say, month or so, when there's positive news, those tend to get sold. And whether that's just a matter of there's just too much positive sentiment on those stocks, and therefore the Wall Street professionals out there just begin to fade them, and yet there may still be upside. I think there is, but I don't really expect huge rocket ships on the vaccine side, simply because, as you were saying, so much has already been baked in. But, there are other places, like I said, leisure, travel, oil, energy, which they're just getting started on that. I even like bank stocks because I think we will see higher interest rates. I think we're seeing the bottom in interest rates right now, as the Fed has sort of made it clear that they're happy to let the economy run hotter. So to me, banks are another place where you can start looking if you're buying, good, strong banks that have good, decent balance sheets.
So Jeff, where does that put you in the context of precious metals? What do you think that the expectation should be for the direction in the price of precious metals? And what is the price action in precious metals telling us about the monetary system?
Yeah, I think that gold, speaking broadly here over the last 5-6 months, and even the move that began before the pandemic, let's go back the last couple of years, realizes that the U.S. has a monetary problem, and gold is the perfect sort of safety valve to go into for that. The only thing I would say is that it's had a fantastic run over the last 6 months, 7 months, 8 months. And I would be a little worried that people are still very, very bullish, just from a sentiment standpoint, on short-term higher gains. And so if the market falls back as the stock market falls back, as I expect in coming months, I would not be surprised to see gold fall back some too. But I would say, keep your focus on what sentiment levels are for gold. And when things start to look really negative, that's your point to start buying. And again, I still like gold juniors and even some of the gold majors that have not really participated that much. I think we're still at the very beginning, say the third inning right now of a larger move in gold and silver for that matter. And frankly, even for a lot of the other base industrial metals, I think there's going to be a lot of money made in all those plus oil in the next handful of years.
Sure. Do you think silver is the better bet over gold at this point?
You know what? I would, simply because it hasn't made such a huge move, and I forget what the gold silver ratio is now, but it's coming off of an extreme in terms of what gold is and what silver is. And if we're expecting that the global economy is going to begin to move at a somewhat faster pace here, then you would definitely want to be buying silver, copper too, because to me all of those point towards this broader shift that I expect from paper assets into real assets, and from things that did well with low interest rates to things that will do well with somewhat higher interest rates.
Yeah, you bet. All right. Well, that's a fantastic wrap up. Let's leave it there for now. I'll look forward to seeing you at the round table on Monday. Have a great weekend.
Thanks, James. You too.